Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at VCX, the Fundrise Innovation Fund.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And a quick note before we get into today's stock. If you trade stocks, crypto, forex, gold, or indices, and want clearer buy and sell signals, you can check out VIP indicators through my link below. Grow $100 to $10 K with VIP indicators. VIP Indicators offers TradingView indicators, market alerts, trading education, and chart reading support with up to a 93% win rate. The tools are designed to help traders spot possible setups faster and trade with more confidence. But please remember, trading is risky. No indicator can guarantee profits, and growing $100 into $10 is not guaranteed. Use these tools for education and analysis only. Manage your risk carefully, do your own research, and never trade money you cannot afford to lose. This is an affiliate link, so I may earn a commission if you use it at no extra cost to you.
So I want you to imagine reaching into your wallet, right? You pull out a crisp $20 bill, and you pay someone over $500 for it. Yeah, simply because it has like Elon Musk's signature on it.
Right.
Mathematically, you are down $480 the second that transaction clears.
Exactly.
But psychologically, you hold something incredibly scarce that almost no one else can get their hands on. And that exact dynamic, that friction between mathematical asset value and just pure, unadulterated retail scarcity that's playing out right now on the New York Stock Exchange.
It really is.
The core thesis we're unpacking today is that VCX is fundamentally democratizing access to the world's most exclusive private tech and space unicorns.
Yeah.
But, from a practical risk-aware standpoint, I am extremely cautious. Because historically, regular investors like you have been completely locked out of these massive pre-IPO gains. So how did we get to a point where the market is willing to pay such an insane premium just for a seat at the table?
All right, let's move into the wealth building context. Because to really grasp why this access premium exists and why it actually matters for your long-term portfolio, we have to look at the massive paradigm shift in how wealth is actually generated in the market today.
Right.
Think back to companies like Amazon or Google. When they went public decades ago, they were still relatively early in their life cycle.
Oh, for sure.
Retail investors who bought shares at the IPO or even shortly after were able to capture life-changing compounding growth over the next decade. But that model is just dead.
Completely dead.
Today, companies are staying private for much, much longer. By the time a modern tech behemoth actually rings the opening bell, the vast majority of the alpha-like, that exponential outsized return, has already been captured in the private markets by venture capitalists.
Yeah, and the mechanism behind that shift is largely regulatory, right?
Yep.
Going public involves brutal SEC compliance, quarterly earnings pressures, and massive underwriting fees. If a company can raise billions privately without dealing with that headache, they obviously will.
Exactly. Why wouldn't they?
But that creates a massive wealth inequality gap because breaking past those gatekeepers is mathematically impossible for the average investor.
Right.
Traditional private equity and venture capital funds typically require you to be an accredited investor, which means hitting these strict SEC income or net worth thresholds. And even if you do qualify, the mechanics of those funds are highly restrictive.
Very.
You're looking at massive capital minimums, often hundreds of thousands of dollars just to buy in. And crucially, your money is locked up, like completely illiquid for 7 to 10 years. You can't just click a button and sell your shares on a Tuesday because you need the cash. Investing in VCX is like finally getting the VIP access code to the boardroom years before the company actually rings the opening bell.
That's a great way to put it, which is why the VCX solution is so disruptive.
Yeah.
It takes that exclusive access to top-tier private tech and packages it into a single publicly traded vehicle on the New York Stock Exchange.
Yeah.
We aren't talking about funding a mid-tier software startup, We are talking about the absolute titans of the modern innovation economy.
The heavy hitters.
Right. Through this one ticker, retail investors are getting direct exposure to OpenAI, Anthropic, SpaceX, and Anduril. These are the companies actively building the infrastructure of the future. And now, for the first time, they are accessible through a standard, highly liquid brokerage account.
Now let's look at the fundamentals, because we need to be incredibly clear about what VCX actually is.
Right.
This is not a standard operating company like an Apple or a Microsoft. And it's not a standard exchange-traded fund or ETF either. It is a closed-end fund. Can you explain the mechanics of why that distinction is so critical for the investor?
It's a vital distinction. With a standard ETF, say, tracking the S&P 500,
Yeah.
the fund manager is constantly creating and destroying shares behind the scenes.
Okay.
And they do that to make sure the share price perfectly matches the value of the underlying stocks.
Yeah.
But a closed-end fund doesn't do that. It issues a fixed number of shares through its listing, and then those shares just trade on the open market. Because the supply of shares is fixed, intense retail demand can drive the share price significantly higher than the actual underlying value of the assets the fund holds.
Which is exactly what we're seeing.
Exactly. The fund doesn't generate traditional operating revenue.
Right.
Its value is driven purely by the capital appreciation of its portfolio companies.
Right, and the portfolio momentum reported here is staggering. Since its inception in July 2022, the fund claims an 84.4% return.
Yeah.
Over just the last year, it's up 63.27%.
Right.
But wait, let me pause you there. An 84% return sounds amazing on a billboard, but how much of that is actual underlying business growth from these private companies, and how much is just retail investors blindly bidding up the stock price?
Well, it's a combination of both, but the underlying fundamental acceleration is genuinely historic. Let's look at the actual math of their core holdings, starting with OpenAI. They recently hit $2 billion in monthly revenue. To put the velocity of that scaling into perspective, they were at $1 billion just at the end of 2024.
That is insane.
They doubled their revenue in a breathtakingly short time frame. We are looking at 900 million weekly active users. That unprecedented level of adoption is what led to their historic $122 billion funding round, which placed them at an $852 billion post-money valuation.
Wow.
So the actual businesses inside the fund are growing at a blistering pace.
Yeah, the scale of an $852 billion valuation is difficult to even conceptualize, but you also have to factor in the aerospace side of the portfolio. Let's look at the SpaceX metrics.
And definitely.
The Starlink division alone, which is essentially blanketing the globe in low Earth orbit internet at this point, generated roughly $10 billion in 2025 revenue. And the projections show that scaling up to $18.7 billion in 2026. But here is the critical analytical question that nobody seems to be answering clearly, How does the massive $1.25 trillion merger between SpaceX and xAI fundamentally re-rate VCX's 5% stake? That merger completely alters the valuation math.
It does, yeah, and it happens through a mechanical recalculation of the cap table. The cap table is essentially the master ledger of who owns what percentage of a company.
Oh.
When SpaceX and xAI merge into a $1.25 trillion combined entity, VCX's proportional slice of that pie undergoes a forced upward revaluation. If you own a 5% stake in a $200 billion asset, and that asset is suddenly absorbed into a $1.25 trillion mega corporation, the dollar value of your underlying shares mechanically steps up.
Just to reflect the new enterprise value.
Exactly. It's not a guess, it's a structural accounting update. And speaking of structural advantages, we have to examine the business model protecting this fund. Traditional venture capital operates on a 2 and 20 model. They take a 2% management fee just for holding your money, regardless of performance, and then take 20% of your total profits.
Which aggressively eats into long-term compounding.
It really does.
But VCX fundamentally disrupts that by operating with a very lean 1.85% annual management fee and no performance fee.
Yeah.
That means a significantly larger share of the underlying capital appreciation accrues directly to you, the shareholder. Furthermore, look at their balance sheet stability. They are sitting on approximately $650 million in net assets. What's crucial here is the structural safety of permanent capital access.
Right.
Because it's a publicly traded, closed-end vehicle, they aren't subject to the traditional venture capital risk of forced liquidations. In a market downturn, a standard VC fund might face a wave of investors demanding their money back.
Yeah. Which forces the fund to sell off its best assets at a massive discount.
Exactly. But VCX's structure prevents that entirely, allowing them to hold their highest conviction bets through brutal market cycles without flinching.
That brings us to the catalyst timeline. Because VCX operates differently than a traditional company, we aren't waiting for a standard quarterly earnings report where they announce how many software subscriptions they sold.
Right.
The massive catalysts here are the upcoming quarterly net asset value, or NAV, updates. Think of NAV in the private markets like a housing appraisal. Your house's actual market value might be going up every single day because the neighborhood is booming.
Sure.
But officially, on the books, that value only updates when an appraiser comes out, or a comparable house is sold.
So we are essentially waiting for the official appraiser to show up and update the books to match reality.
Exactly. When OpenAI closes an $852 billion valuation round, that isn't instantly reflected in VCX's internal accounting by the second.
Right, it takes time.
It happens during these quarterly NAV updates. Those step-ups are tangible drivers of fundamental value. And looking slightly further out, we have the highly speculative, but incredibly potent 2026 IPO wave.
Oh, yeah. The rumors there are crazy.
There is massive momentum and industry chatter surrounding potential public offerings for OpenAI, Anthropic, or SpaceX. If any of those core holdings announce an S-1 filing to go public, the visibility and retail frenzy surrounding VCX as the premier vehicle holding those assets will be a phenomenal psychological catalyst.
Yeah, I also want to bring an analytical lens to the macro environment right now because broader economic conditions are acting as a massive invisible tailwind for this specific portfolio. We are currently in an environment of rate cuts by the Federal Reserve.
Right.
And why does that matter? It comes down to corporate finance mechanics. When analysts value a high-growth tech company, they project all the cash it will make years in the future and discount it back to today's dollars. The interest rate is essentially the gravitational pull on that future cash.
That's a good analogy.
If rates are high, future cash is worth substantially less today. But when the Fed cuts rates, that gravity weakens. Suddenly, those future billions from SpaceX or Endural mathematically translate to a much higher valuation right now without the companies changing a single thing about their daily operations.
Exactly.
When you connect that macro reality to the heavy defense and AI infrastructure themes dominating VCX's portfolio, you have a perfect storm for mechanical valuation expansion.
Now let's pivot to the chart. Because if the macro environment is creating a perfect storm for valuation, the chart shows us that psychology has completely overtaken the math.
Yeah, it really has.
We have to talk about the post-listing explosion. Following VCX's direct listing on the New York Stock Exchange on March 19, 2026, we saw an explosive, completely psychological breakout. The price skyrocketed from a baseline net asset value of $18.26 to an astonishing peak of $533.
Which is wild.
That is a 25x premium over the actual appraised value of the underlying assets.
Yeah, and you're probably listening to this looking at that $533 peak and thinking, who in their right mind pays a 25x premium for anything? It's mathematically unsustainable in the long run.
Right.
Since that violent peak, the price has corrected sharply, settling into the $189 to $262 range.
Yeah.
But even at that significantly corrected level, we are still looking at a massive premium.
We are.
What the market is doing is pricing in an access premium. Retail investors aren't treating this like a standard equity. They are treating it like a rare collectible. They are willing to pay significantly more than the baseline $18 NAV simply because there is literally no other way to buy into these scarcity assets.
Yeah.
But to truly understand why the price squeezed that high, we have to analyze the mechanical supply and demand imbalance.
Right. The volatility and massive volume we are seeing are off the charts. And it is entirely driven by a structural quirk in how the fund was listed. There was a 6-month lockup agreement in place for early investors and insiders. This has resulted in an exceptionally low public float. There are very few actual shares available to trade on the open market right now.
It's like a high-stakes auction where there are 1 million eager buyers, but only 10 tickets available.
Exactly.
The price of those 10 tickets skyrockets, not because the concert got better, but because of sheer scarcity. So you have a situation pitting massive retail FOMO, the fear of missing out on the AI and space race directly against short sellers.
Yeah.
The short sellers are looking purely at the math. They see stock trading near $200 with an asset value of $18, and they are betting heavily on a crash. It is a technical pressure cooker.
So what does market sentiment look like? If we separate the institutional action from the retail action, the distribution network is staggering. You have over 2 million existing Fundrise users, and currently, more than 100,000 retail investors are actively accumulating VCX shares.
That's a lot of buyers.
It is a massive, highly sticky retail base that believes in the long-term vision. But it's not just retail hype driving the underlying value. There is immense institutional validation backing these specific assets.
Right.
When you look at OpenAI's recent funding round, it was anchored by the absolute titans of the tech industry: Amazon, NVIDIA, SoftBank, and Microsoft. VCX is investing right alongside the smartest, most ruthlessly analytical, capitalized institutional money in the world.
But despite that fundamental validation of the underlying companies, the mood on Wall Street regarding the VCX ticker itself is intensely polarized. Nobody's bearish on SpaceX, you know?
Right, of course not.
Nobody thinks OpenAI is a failing company. Everyone is fundamentally bullish on the assets. The narrative clash is entirely focused on VCX's price mechanics.
Yeah.
The market is violently divided on whether that access premium is justified. You have specific targeted short seller attacks happening right now. Citron Research, which is a very prominent short-selling firm, has publicly targeted the stock. They are specifically attacking that massive NAV premium, betting that the mechanics of supply and demand will eventually pull the share price violently back down to the actual $18 value of the assets.
Now let's talk about the risks.
And we must be extremely clear-eyed about the bear case here, because the mechanics of a potential crash are very real. The biggest, most immediate risk to any investor buying at these current levels is the violent potential for NAV premium compression. We just discussed the low float, the high stakes option with only 10 tickets.
Right.
The critical danger zone is coming up when that 6-month lockup expires in September 2026. When that happens, millions of newly unlocked shares are going to be handed to early insiders. If those insiders decide to click sell and take their profits, a massive flood of new supply will hit the public float. If there isn't an equal wave of retail demand waiting to absorb millions of shares at a $200 premium, the supply overwhelms the order book. The price mechanically collapses until it finds buyers, potentially triggering a drawdown of up to 90% if it reverts all the way back down to the $18 NAV.
That is the mechanical risk of the lockup expiration, certainly.
There is also reputational and regulatory scrutiny to factor in. Beyond the Citron short report, there is past compliance friction. Fundrise had a $0 settlement with the SEC back in 2023 regarding undisclosed influencer payments.
Right.
While it didn't result in a financial penalty, in an environment where the SEC is heavily scrutinizing how private assets are marketed to retail investors, past compliance friction is a legitimate risk factor that practical investors must weigh.
I hear that skepticism, but I'm going to push back strongly on the bear case, particularly regarding that massive valuation gap. Yes, the premium looks mathematically terrifying if you only look at a static snapshot. But we have to understand how NAV works in the private markets. It is naturally backward-looking. Public markets are forward-looking. They update by the second based on future expectations. Private NAV relies on mark-to-market valuations that only officially update when a funding round closes.
Right.
As these underlying mega rounds for companies like Anthropic and Anduril close, that $18 NAV is going to organically step up to match the public pricing. Furthermore, we shouldn't just look at the current share price as an irrational, hype-driven premium.
What is it then?
It is the literal structural cost of early access and daily liquidity. You are paying for the unprecedented privilege of holding pre-IPO SpaceX in a liquid account where you can sell it tomorrow if you want to. In the private markets, that liquidity simply does not exist.
That's a fair point.
And regarding the regulatory hurdles, I actually see their history as a massive competitive moat. Fundrise has a first-mover advantage here. They have successfully cleared over 120 public offerings with the SEC.
Wow, okay.
They have already navigated the brutal, exhausting regulatory labyrinth of bringing private assets to the public market. They've turned what is a massive barrier to entry for their competitors into a permanent structural advantage for VCX.
So with everything on the table, what's the final verdict?
The official bullish score for VCX stands at a strong 7. If I were to give you the elevator pitch, it's this. VCX is currently the only liquid gateway into the world's most consequential pre-IPO unicorns. It is uniquely positioned to capture a decade-long shift of wealth generation from public to private markets.
Right.
However, my long-term view demands a strict multi-year hold horizon. You have to be prepared to ride out the short-term premium volatility, especially around that upcoming lockup expiration in September. But a multi-year horizon allows you to safely capture the full pre-IPO to public life cycle of these underlying assets. You are giving the fundamental NAV expansion the time it needs to catch up to the current market enthusiasm.
That leaves you with a fascinating question to ponder as you look at your own portfolio. What happens to the traditional stock market when the most innovative, world-changing companies no longer need an IPO to build their empires? Are you prepared for a future where your public brokerage account isn't just buying blue-chip legacy stocks, but actively funding the next mission to Mars? Keep that in mind as we watch this space evolve. And if you want extra help reading trading charts, you can check out VIP indicators through the link below. The campaign is grow $100 to $10K with VIP indicators, and their tools include TradingView indicators, market alerts, and trading education with up to a 93% win rate. But trading always carries risk, and no profits are guaranteed. Use the tools for education and analysis, manage your risk carefully, and always do your own research before making any trade. This is an affiliate link, and I may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.